We're live, we're live, we're live, we're live. We're up, we're up, we're up. We're stocking ONCT into tomorrow. Swing trade into tomorrow. ONCT. Today's big winner, Davesplay, Altm. I was up over $500 on that one. Sold at 80%. Altm. Please like the live. We're stocking ONCT into the close for continuation tomorrow. Also, Altm, it may continue tomorrow. It's up 186% at 28.30 a few minutes ago. I'm not sure the price right now. This morning I bought at 17. This is Altm. I bought at 16.12. I bought more at 14.70. And I sold 80% of my holdings at 27.06. Altm, today's big winner. NEO. On Saturday, on my live, I told you I'm going to buy NIO on Monday. Right now, I'm up 30%. NIO. I told you this one is going to 100. NIO. Markets are looking strong. 3 consecutive up days. What else we got going on? ACB popped. HOFV. ALTM is at $28. Went as high as $30 today. 31.90. So today's range was 16.72 to 31.90. If you traded 4 a.m. with Webull, you'd get in at $14. So I loaded up at 17, 16, and $14.70 in the pre-market. Sign up with Webull. You get 4 a.m. trading. Decent prices. All right. What else is running? TH. TH is up 46%. But this one is not tradable on Webull. YGYI is back again. They're up 46% at 61 cents. But it's dropping, so it might not continue tomorrow. So my portfolio for this week on Webull, I'm up 10%. UPWK is up 43% at 29 bucks. UPWK, let me write that down.
Accumulating positions that are big enough to bully the markets. The CFTC divides all market participants into three groups: commercials, small speculators, and large speculators. Commercials, also known as hedgers, are firms or individuals who deal in actual commodities in the normal course of business. In theory, they trade futures to hedge business risks. For example, a bank trades interest rate futures to hedge its loan portfolio, or a processing company trades wheat futures to offset the risks of buying grain. Hedgers post small margins and are exempt from speculative position limits. Large speculators are those traders whose positions reach reporting levels. The CFTC reports buying and selling by commercials and large speculators. To find the positions of small traders, you need to subtract the holdings of the first two groups from the open interest. The divisions between hedgers, big speculators, and small speculators are somewhat artificial. Smart small traders grow into big traders, dumb big traders become small traders, and many hedgers speculate. Some market participants play games that distort the CFTC reports. For example, an acquaintance who owns a brokerage firm sometimes registers his wealthy speculator clients as hedgers.
I'm eating right now.
They trade stock index and bond futures to hedge their stock and bond positions. The commercials can legally speculate in the futures markets using inside information.
Keep a stock on
Some of them are big enough to play futures markets
for
against
continuation.
cash markets. For example, an oil
ONCT, also Altm.
Divert several
it might continue to run
and hold them offshore in order to tighten supplies and push futures prices up. They can take profits on long positions, go short, and deliver several tankers at once to refiners in order to push crude futures down and cover shorts. This manipulation is illegal, and most firms hotly deny that it takes place. As a group, the commercials have the best track record in the futures markets. They have inside information and are well capitalized. It pays to follow them because they are successful in the long run. The few exceptions, such as orange juice hedgers, only confirm this rule. Big speculators used to be highly successful as a group until a decade or so ago. They used to be wealthy individuals who took careful risks with their own money. Today's big traders are commodity funds. These trend-following behemoths do poorly as a group. The masses of small traders are the proverbial wrong-way Corrigans of the markets. It is not enough to know whether a certain group is short or long. Commercials are often short futures because many of them own physical commodities. Small traders are usually long, reflecting their perennial optimism. To draw valid conclusions from the CFTC reports, you need to compare current positions
And
to their
NDM is back.
historical norms.
All right, let me make a note of that, Kay.
Trading systems. The triple screen trading system.
And NDM.
The triple screen trading system was developed by this author and has been used for trading since 1985. It was first presented to the public in April 1986 in an article in Futures magazine. Triple screen applies 3 tests
What else you watching?
to every trade. Many trades that seem attractive at first are rejected by one or another screen. Those trades that pass the triple screen test have a higher degree of profitability.
27%. How comes I didn't see that?
Triple screen combines trend-following methods and counter-trend
I gotta
techniques.
check that out.
It analyzes all potential trades in several time frames. Triple screen is more than a trading
PLTR.
system. It is a method, a style of trading. Beginners
I'm gonna
often
write
look
it down.
for a magic bullet, a single indicator for making money.
Okay.
If they get lucky for a while, they feel as if they discovered the royal road to profits. When the magic dies, amateurs give back their profits with interest and go looking for another magic tool. The markets are too complex to be analyzed with a single indicator. Different indicators give contradictory signals in the same market. Trend-following indicators rise during uptrends and give buy signals, while oscillators become overbought and give sell signals. Trend-following indicators turn down in downtrends and give signals to sell short, but oscillators become
eating
oversold
right now
and give buy signals. Trend-following indicators are profitable when markets are moving, but lead to whipsaws in trading ranges. Oscillators are profitable in trading ranges, but give premature and dangerous signals when the
markets are looking strong.
Traders say, the trend is your friend,
three consecutive updates.
let your profits run. They also say, buy low, sell high. But why sell if the trend is up? And how high is high? Some traders try to average out the votes of trend-following indicators and oscillators. It is easy to rig this vote.
Thank you for the likes.
If you use more trend-following tools, the vote will go one way. And if you use more oscillators, it will go the other way. A trader can always find a group of indicators telling him what he wants to hear. The triple screen trading system combines trend-following indicators with oscillators. It is designed to filter out their disadvantages while preserving their strengths. Another major dilemma is that the trend can be up and down at the same time, depending on what chart you use. A daily chart may show an uptrend, while a weekly chart shows a downtrend, and vice versa.
Thanks for the
A trader needs to handle conflicting signals in different time frames. Charles Dow, the author of the venerable
5 minutes to market close.
stated at the turn of the century that the stock market had 3 trends. The
ONCT
long-term trend lasted
for an
several
overnight
years.
swing.
The intermediate trend, several months. And anything shorter
Also,
than that was a minor
ALTM
trend.
might continue tomorrow. Let's
Robert
see.
Rhea, the great market technician of the 1930s, compared the 3 market trends to a tide, a wave, and a ripple. He believed that traders should trade in the direction of the market tide and take advantage of the waves, but ignore the
Neville in
ripples.
the building.
Times have changed, and the markets have become more volatile. Traders
Welcome,
need a
Neville,
more
in the
flexible
building.
definition of time frames. The triple screen trading system is based on the observation that every time frame relates to the larger and shorter ones by
OTT.
a factor of 5. Each trader
We want to
needs to
do an
decide
overnight
which
swing on
time
this
frame
one.
he wants to trade. Triple screen calls
Buy
that
now,
the
sell in the
intermediate
AH
time.
or
The
tomorrow morning.
long-term time frame is one order of
Also
magnitude longer.
ALTM, they might
The
continue.
short-term time
Davesplay,
frame is
big
one
winner
order
today,
of magnitude
186%
shorter. For
at
example, if you want
28.35.
to
It
carry
went
a
as high
trade
as
for several days or
31.90.
weeks, then your intermediate time frame will be
The day's low
defined
was
by the daily charts.
1672, but if you
Weekly charts are
started
one
trading in the
order of magnitude
pre-market
longer, and they
with
determine the
Webull 4
long-term time
a.m.,
frame.
you'd have got
Hourly
in at
charts
14
are one
bucks.
order of magnitude shorter, and they determine the short-term
I
time
was
frame.
adding at 17,
Day traders who hold their positions for
$16 and
less than an hour
14.70.
can use the same principle.
I sold 80%
A
of my
10-minute
holdings
chart
at
may define the intermediate time frame,
27.06.
an hourly chart the
This
long-term
is
time frame, and a 2-minute
ALTM.
chart the short-term time frame. Triple screen demands that you examine the long-term chart
Please like the live.
first. It allows you to trade only in the direction of the tide, the trend on the long-term chart. It uses the waves that go against the tide for entering positions. For example, daily declines create buying opportunities when the weekly trend is up. Daily rallies provide shorting opportunities when the weekly trend is down. First screen, market tide. Triple screen begins by analyzing the long-term chart, one order of magnitude greater than the one you plan to trade. Most traders pay attention only to the daily charts, with everybody watching the same few data. If you begin by analyzing weekly charts, your perspective will be 5 times greater than that of your competitors. The trader has 3 choices: buy, sell, or stand aside. The first screen of the triple screen trading system takes away one of those choices. It acts as a censor who permits you only to buy or stand aside during major uptrends. It allows you to sell short or stand aside during major downtrends. You have to swim with the tide or stay out of the water. Second screen, market wave. The second screen identifies the wave that goes against the tide. When the weekly trend is up, daily declines point to buying opportunities. When the weekly trend is down, daily rallies point to shorting opportunities. The second screen applies oscillators to the daily charts in order to identify deviations from the weekly trend.
Never green 4, meaning what? The
Oscillators
Dow?
give buy signals when markets decline and sell signals when markets rise. The second screen of the triple screen trading system allows you to take only those daily signals that point in the direction of the weekly trend. Third screen, intraday breakout. The first screen of the triple screen trading system identifies market tide on a weekly chart. The second screen identifies a wave that goes against that tide on a daily chart. The third screen identifies the ripples in the direction of the tide. It uses intraday price action to pinpoint entry points. The third screen does not require a chart or an indicator. It is a technique for entering the market after the first and second screens gave a signal to buy or sell short. The third screen is called a trailing buy stop technique in uptrends and a trailing sell stop technique in downtrends. When the weekly trend is up and the daily trend is down, trailing buy stops catch upside breakouts. When the weekly trend is down and the daily trend is up, trailing sell stops catch downside breakouts.
Okay, I thought it was 3 days.
And a daily oscillator
Okay, so that's
declines,
good.
it activates a trailing buy
4 green
stop
days in a row.
technique. Place a buy order
I'll take
one
it.
tick above the high of the previous day. If prices rally, you will be stopped in long automatically when the rally takes out the previous day's high. If prices continue to decline, your buy stop will not be touched. Lower your buy order the next day to the level 1 tick above the latest price bar. Keep lowering your buy stop each day until stopped in or until the weekly indicator reverses and cancels its buy signal. When the weekly trend is down, wait for
Killers, it's like MJ out there in the market.
Trailing sell stop technique. Place an order to sell short one tick below the latest bar's low. As soon as the market turns down, you will be stopped in on the short side. If the rally continues, keep raising your sell order daily. The aim of a trailing sell stop technique is to catch an intraday downside breakout from a daily uptrend in the direction of a weekly downtrend. Proper money management is essential for successful trading. A disciplined trader cuts his losses short and outperforms a loser who keeps hanging on and hoping. The triple screen trading system calls for placing very tight stops. As soon as you buy, place a stop loss order one tick below the low of the trade day or the previous day, whichever is lower. Once you sell short, place a protective stop loss one tick above the high of the trade day or the previous day, whichever is higher. Move your stop to a break-even level as soon as the market moves in your favor. Afterwards, the rule of thumb is to move your stop to protect approximately 50% of paper profits. The reason for using such tight stops is that triple screen trades only in the direction of the tide. If a trade does not work out fast, it is a sign that something is fundamentally changing below the surface of the market. Then it is better to run fast. The first loss is the best loss. It allows you to re-examine the market from the safety of the sidelines. Conservative traders should go long or short on the first signal of the triple screen trading system and stay with that position until the major trend reverses or until stopped out. Active traders can use each new signal from the daily oscillator for pyramiding the original position. A position trader should try and stay with a trade until the weekly trend reverses. A short-term trader may take profits using signals from the second screen. For example, if a trader is long and force index becomes positive,
I'm listening to
or stochastic rises to 70%, he may sell and take profit.
Trading for a Living by Dr. Alexander Elder.
Several types of indicators. It uses a trend-following indicator with the long-term charts and a short-term oscillator with the intermediate charts. It uses special entry techniques for buying or selling short. It also uses tight money management rules. Channel trading systems. Prices often flow in channels, the way rivers flow in valleys. When a river touches the right edge of its valley, it turns left. When a river touches the left rim of its valley, it turns right. When prices rally, they often seem to stop at an invisible ceiling. When they fall, they often seem to hit an invisible floor. Channels help traders identify buying and selling opportunities and avoid.
Check him out on my playlist.
Channels parallel to trend lines are useful for long-term analysis, especially on the weekly charts. Channels around moving averages are useful for short-term analysis.
Let him put you to sleep at night.
And intraday charts. Channels whose width depends on volatility are good for catching early stages of major new trends.
Let all that knowledge permeate through your brain.
Buyers buy with greater intensity than sellers sell.
Sink into your subconscious.
Resistance is where sellers sell with greater intensity than buyers buy. Channels show where to expect support and resistance in the future. A channel slope identifies a market's trend. When a channel lies flat, you may trade all swings within its walls.
Don't hold and hope.
When a channel rises, it pays to trade only from the long side, buying at the lower wall and selling at the upper wall. When a channel declines, it pays to trade only from the short side, shorting at the upper channel wall and covering at the lower wall. When prices rise above the average consensus of value, sellers see an opportunity to take profits on long positions or go short. When they overpower the bulls, prices decline. When prices fall below the moving average, bargain hunters step in. They're buying and short covering by bears lift prices, and the cycle repeats. When prices are near their moving average, the market is fairly valued. When prices are at or below the lower channel line, the market is undervalued. When prices are at or above the upper channel line, the market is overvalued. Channels help traders find buying opportunities when the market is cheap and shorting opportunities when the market is dear. The market is like a manic depressive person. When he reaches the height of mania, he's ready to calm down. And when he reaches the bottom of his depression, his mood is ready to improve. A channel marks the limits of mass optimism and pessimism. Its upper line shows where bulls run out of steam, and its lower line shows where bears become exhausted. Every animal fights harder closer to home. The upper channel line shows where bears have their backs against the wall and fight off the bulls. The lower channel line shows where bulls have their backs against the wall and fight off the bears. When a rally fails to reach the upper channel line, it is a bearish sign. It shows that bulls are becoming weaker. If a rally shoots out of a channel and prices close above it, it shows that the uptrend is strong. The reverse rules apply in downtrends. Channels help traders who use them remain objective when others get swept up in bullish or bearish hysteria. If prices touch the upper channel line, you see that mass bullishness is being overdone, and it is time to think about selling. When everyone turns bearish, but prices touch the lower channel line, you know that it is time to think about buying instead of selling. Amateurs and market professionals handle channels differently. Amateurs bet on long shots. They tend to buy upside breakouts and sell short downside breakouts. When an amateur sees a breakout from a channel, he hopes that a major new trend is about to begin and make him rich quick. Professionals trade against deviations and for a return to normalcy. It is normal for prices to remain within channels. Most breakouts are exhaustion moves that are quickly aborted. Professionals like to fade them, trade against them. They sell short as soon as an upside breakout stalls and buy when a downside breakout stops reaching new lows. Breakouts can produce spectacular gains for amateurs when a major new trend blows out of a channel. Amateurs occasionally win, but it pays to trade with the professionals. Most breakouts are false and are followed by reversals. Risk management. Trading is so exciting that it often makes amateurs feel high. A trade for them is like a ticket to a movie or a professional ball game. Trading is a much more expensive entertainment than the cinema. Nobody can get high and make money at the same time. Emotional trading is the enemy of success. Greed and fear are bound to destroy a trader. You need to use your intellect instead of trading on gut feeling. A trader who gets giddy from profits is like a lawyer who starts counting cash in the middle of a trial. A trader who gets upset at losses is like a surgeon who faints at the sight of blood. A real professional does not get too excited about wins or losses. The goal of a successful professional in any field is to reach his personal best, to become the best doctor, the best lawyer, or
Please
the best
like the
trader.
live.
Money flows to them almost as an afterthought. You need to concentrate on trading right and not on the money. Each trade has to be handled like a surgical procedure, seriously, soberly, without sloppiness or shortcuts. Emotional traders want certain gains and turn down profitable wagers that involve uncertainty. They go into risky gambles to avoid taking certain losses. It is human nature to take profits quickly and postpone taking losses. Irrational behavior increases when people feel under pressure. Emotional trading destroys losers. If you review your trading records, you will see that the real damage to your account was done by a few large losses or by long strings of losses while trying to trade your way out of a hole. Good money management would have kept you out of the hole in the first place. You can win only if you trade with a positive mathematical expectation, a sensible trading system. Trading on hunches leads to disasters. Many traders act like drunks wandering through a casino, going from game to game. Slippage and commissions destroy those who overtrade. The best trading systems are crude and robust. They are made of a few elements. The more complex the systems, the more elements that can break. Traders love to optimize their systems using past data. The trouble is, your broker won't let you trade the past. Markets change, and the ideal parameters from the past may be no good today. Try to de-optimize your system instead. Check how it would have performed under bad conditions. A robust system holds up well when markets change. It is likely to beat a heavily optimized system in real-world trading. Finally, when you develop a good system, don't mess with it. Design another one if you like to tinker. As Robert Krechter put it, most traders take a good system and destroy it by trying to make it into a perfect system. Once you have your trading system, it is time to set the rules for money management. Suppose you and I bet a penny on a coin flip. Tails you win, heads you lose. Suppose you have $10 of risk capital and I have $1. Even though I have less money, I have little to fear. It would take a string of 100 losses to wipe me out. We can play for a long time, unless two brokers get between us and drain our capital by commissions and slippage. The odds will dramatically change if you and I raise our bet to a quarter. If I have only $1, then a string of only 4 losses will destroy me. If you have $10, you can afford to lose a quarter 40 times in a row. A series of 4 losses is likely to come much sooner than 40. All other factors being equal, the poorer of two traders is the first to go broke. Most amateurs think that other factors are far from equal. They consider themselves brighter than the rest of us. The trading industry works hard to reinforce that delusion, telling traders that winners get the money lost by losers. They try to hide the fact that trading is a minus-sum game. Cocky amateurs take wild risks, producing commissions for brokers and profits for floor traders. When they blow themselves out of the market, new suckers come in because hope springs eternal. Institutional traders as a group tend to be more successful than private traders. They owe it to their bosses, who enforce discipline. If a trader loses more than his limit on a single trade, he is fired for insubordination. If he loses his monthly limit, his trading privileges are suspended for the rest of the month and he becomes a gopher, fetching other traders coffee. If he loses his monthly limit several times in a row, the company either fires or transfers him. This system makes institutional traders avoid losses. Private traders have to be their own enforcers. An amateur who opens a $20,000 trading account and expects to run it into $1 million in 2 years is like a teenager who runs away to Hollywood to become a pop singer. He may succeed, but the exceptions only confirm the rule. Amateurs like to get rich quick, but destroy themselves by taking wild risks. They may succeed for a while, but hang themselves, given enough rope. Amateurs often ask me what percentage profit they can make annually from trading. The answer depends on their skills or lack of such and market conditions. Amateurs never ask a more important question. How much will I lose before I stop trading and reevaluate myself, my system, and the markets? If you focus on handling losses, profits will take care of themselves. A person who makes 25% profit annually is a king of Wall Street. Many top-flight money managers would give away their firstborn child to to be able to top this. A trader who can double his money in a year is a star, as rare as a pop musician or a top athlete. If you set modest goals for yourself and achieve them, you can go very far. If you can make 30% annually, people will beg you to manage their money. If you manage $10 million, not an outlandish amount in today's markets, your management fee alone can run 6% of that, or $600,000 a year. If you make a 30% profit, you will keep 15% of it as an incentive fee, another $450,000. You will earn over $1 million a year trading without taking big risks. Keep these numbers in mind when you plan your next trade. Trade to establish the best track record with steady gains and small drawdowns. Most traders get killed by one of two bullets: ignorance or emotion. Amateurs act on hunches and stumble into trades that they should never take due to negative mathematical expectations. Those who survive the stage of virginal ignorance go on to design better systems. When they become more confident, they lift their heads out of the foxholes, and the second bullet hits them. Confidence makes them greedy. They risk too much money on a trade, and a short string of losses blows them out of the market. If you bet a quarter of your account on each trade, your ruin is guaranteed. You will be wiped out by a very short losing streak, which happens even with excellent trading systems. Even if you bet a tenth of your account on a trade, you will not survive much longer. A professional cannot afford to lose more than a tiny percentage of his equity on a single trade. An amateur has the same attitude toward trading as an alcoholic has toward drinking. He sets out to have a good time, but winds up destroying himself. Extensive testing has shown that the maximum amount a trader may lose on a single trade without damaging his long-term prospects is 2% of his equity. This limit includes slippage and commissions. If you have a $20,000 account, you may not risk more than $400 on any trade. If you have a $100,000 account, you may not risk more than $2,000 on a trade. But if you have only $10,000 in your account, then you can risk no more than $200 on a trade. Most amateurs shake their heads when they hear this. Many have small accounts, and the 2% rule throws a monkey wrench into the dreams of quick profits. Most successful professionals, on the other hand, consider the 2% limit too high. They do not allow themselves to risk more than 1% or 1.5% of their equity on any single trade. The 2% rule puts a solid floor under the amount of damage the market can do to your account. Even a string of 5 or 6 losing trades will not cripple your prospects. In any case, if you are trading to create the best track record, you will not want to show more than a 6% or 8% monthly loss. When you hit that limit, stop trading for the rest of the month. Use this cooling off period to re-examine yourself, your methods, and the markets. The 2% rule keeps you out of riskier trades. When your system gives an entry signal, check to see where to place a logical stop. If that would expose more than 2% of your account equity, pass up that trade. It pays to wait for trades that allow very close stops. Waiting for them reduces the excitement of trading, but enhances profit potential. You choose which of the two you really want. The 2% rule helps you decide how many contracts to trade. For example, if you have $20,000 in your account, you may risk up to $400 per trade. If your system flags an attractive trade with a $275 risk, then you may trade only one contract. If the risk is only $175, then you can afford to trade 2 contracts. What about pyramiding? Increasing the size of your trading positions as a trade moves in your favor. The 2% rule helps here too. If you show profit on a trend-following position, you may add to it, as long as your existing position is at a break-even level or better, and the risk on the additional position does not exceed 2% of your equity. goal of a successful trader is to make the best trades. Money is secondary. If this surprises you, think how good professionals in any field operate. Good teachers, doctors, lawyers, farmers, and others make money, but they do not count it while they work. If they do, the quality of their work suffers. If you ask your doctor how much money he earned today, he won't be able to answer, and if he can, you do not want him for a doctor. Ask your lawyer how much money he made today. He may have a general idea that he put in some billable hours, but not exactly how many dollars he made. If he counts money while he works, you do not want him for a lawyer. A real pro devotes all his energy to practicing his craft the best he can, not to counting money. Counting money in a trade flashes a red light, a warning that you are about to lose because your emotions are kicking in and they will override your intellect. That is why it is a good idea to get out of a trade if you cannot get money off your mind. Concentrate on quality, on finding trades that make sense, and having a money management plan that puts you in control. Focus on finding good entry points and avoid gambles. Then the money will follow almost as an afterthought. You may count it later, well after a trade is over. A good trader must focus on finding and completing good trades. A professional always studies the markets, looks for opportunities, hones his money management skills, and so on. If you ask him how much money he made on the current trade, he will have only a general idea of being a little or a lot ahead of the game or a little behind. He can never be a lot behind because of tight stops. Like other professionals, he focuses on practicing his craft and polishing his skills. He does not count money in a trade. He knows that he will make money as long as he does what is right in the markets. If you use indicators for finding trades, use them also to get you out of trades. If your indicators are in gear with the market when it is time to buy or go short, use them to decide when it is time to sell or to cover. A trader often becomes emotionally attached to a trade. Profits give people a high, but even a loss can tingle the nerves, like a scary but exciting ride on a roller coaster. When those indicator signals that flagged a trade disappear, get out of the market fast, regardless of your feelings. Some traders try to establish profit targets. They want to sell strength when prices hit resistance or buy weakness when prices reach support. Elliott wave theory is the main method for trying to forecast reversal points. R.N. Elliott wrote several articles about the stock market and a book, Nature's Law. He believed that every movement in the stock market could be broken into waves, smaller waves, and subwaves. Those waves explained every turning point and occasionally allowed him to make correct predictions. Those analysts who sell advisory services based on Elliott's methods always come up with so-called alternate counts. They explain everything in hindsight, but are not reliable in dealing with the future. Fibonacci numbers and their ratios, especially 1.618, 2.618, and 4.236, express many relationships in nature. As Trudy Garland writes in her lucid book, Fascinating Fibonacci's, these numbers express the ratios between the diameters of neighboring spirals in a seashell and in a galaxy, the number of seeds in the adjacent rows of a sunflower, and so on. Elliott was the first to point out that these relationships also apply to the financial markets. Tony Plummer describes in his book, Forecasting Financial Markets, how he uses Fibonacci ratios to decide how far a breakout from a trading range is likely to carry. He measures the height of a trading range, trades in the direction of a breakout, and then looks for reversal targets by multiplying the height of the range by Fibonacci numbers. Experienced traders combine profit targets with other technical studies. They look for indicator signals at the projected turning points. If indicators diverge from a trend that is approaching a target, it reinforces the signal to get out. Trading on targets alone can be a tremendous ego boost, but the markets are too complex to be handled with a few simple numbers. Setting stops. Serious traders place stops the moment they enter a trade. As time passes, stops need to be adjusted to reduce the amount of money at risk and to protect a bigger chunk of profit. Stops should be moved only one way, in the direction of the trade. We all like to hope that a trade will succeed, and a stop is a piece of reality that prevents traders from hanging on to empty hope. When you are long, you may keep your stops in place or raise them, but never raise them. Cutting extra slack to a losing trade is a loser's game. If a trade is not working out, it shows that your analysis was flawed or the market has changed. Then it is time to run fast. Serious traders use stops the way sailors use ratchets, to take out the slack in their sails. Losers who move stops away from the market vote in favor of fantasy and against reality. Learning to place stops is like learning to drive defensively. Most of us learn the same techniques and we adjust them to fit our personal styles. The following are the basic rules for placing stops. 1. Stop loss order. Place your stop the moment you enter a trade. Trading without a stop is like walking down Fifth Avenue in Manhattan without pants on. It can be done. I have seen people do it, but it is not worth the trouble. A stop will not protect you from a bad trading system. The best it can do is slow down the damage. A stop loss order limits your risk, even though it does not always work. Sometimes prices gap through a stop. A stop is not a perfect tool, but it is the best defensive tool we have. When you go long, place your stop below the latest minor support level. When you go short, place a stop above the latest minor resistance. The parabolic system moves the stop in the direction of the trade depending on the passage of time and changes in prices. If you use the triple screen trading system, place your stop after entering a trade at the extreme of the past 2 days' range. Avoid all trades where a logical stop would expose more than 2% of your equity. This limit includes slippage and commissions. 2. Break-even order. The first few days in a trade are the hardest. You have done your homework, found a trade, and placed an order. It has been filled, and you placed a stop-loss order. There is not much else you can do. You are like a pilot strapped into his seat for takeoff. The engines are blasting at full power, but the speed is low, and there is no room to maneuver. Just sit back and trust your system. As soon as prices start to move in your favor, move your stop to a break-even level. When the takeoff is completed, your flight is at a safer stage. Now you get to choose between keeping your money or gaining more, instead of choosing between a loss and a gain. As a rule, prices have to move away from your entry point by more than the average daily range before you move your stop to a break-even level. It takes judgment and experience to know when to do it. When you move a stop to a break-even level, you increase the risk of a whipsaw. Amateurs often kick themselves for leaving money on the table. Many amateurs allow themselves only one entry into a trade. There is nothing wrong with re-entering a trade after getting stopped out. Professionals keep trying to get in until they get a good entry using tight money management.
I am social in the building, yes.
3.
I'm swinging
Profit
ONCT.
order.
And also
As
I'm
prices
leaving
continue
some on the
to
table,
move in your favor,
ALTM.
You have to protect
I
your
sold
paper
out
profits.
80%.
Paper profit
And I'm holding the
is
rest
real
overnight.
money. Treat it with the same respect as money in your wallet.
ALTM and
Risk only a portion of it as the
OMCT.
price of staying in the trade. If you are a conservative trader, apply the 2% rule to your paper profits. This protect profit order is a money stop. protecting your equity.
Please like the live.
Keep moving it in the direction of the
Thanks
trade
for stopping
so that
by.
no more than 2%
I am
of
social.
your growing equity is ever exposed. More aggressive traders use the 50% rule. If you follow it, half the paper profit is yours and half belongs to the market. You can mark the highest high reached in a long trade or the lowest low reached in a short trade and place your stop halfway between that point and your entry point. For example, if prices move 10 points in your favor, place a stop to protect 5 points of profit. If in doubt, use the parabolic system to help you adjust your stops. When you are not sure whether to stay in a trade or not, take profits and reevaluate the situation from the sides. There is nothing wrong with exiting and re-entering a trade. People think much more clearly when they have no money at risk. A trade does not end when you close out your position. You must analyze it and learn from it. Many traders throw their confirmation slips into a folder and go looking for the next trade. They miss an essential part of growing to become a professional trader: review and self-analysis. Identified a good trade? Which indicators were useful and which did not work? How good was your entry? Was the initial stop too far?
What if
or
it
too
doesn't
close?
drop?
Why? By how much? Did you
What
move
if it
your
keeps
stop
going?
to a break-even level too early or too late? Were your protect profit stops
Try a
too
small
loose or
position.
too tight? Did you recognize
Market
the
conditions
signals to
are
exit the
favorable.
trade? What should you have done differently? What did you feel at the various stages of the trade? This analysis is an antidote against emotional trading. Ask yourself these and other questions and learn from your experiences. A cool, intelligent analysis does you more good than gloating about profits or wallowing in regrets. Start keeping a before and after notebook. Whenever you enter a position, print out the current charts. Paste them on the left page of your notebook and jot down your main reasons for buying or shorting. Write down your plan for managing the trade. When you exit, print the charts again and paste them on the right page of your notebook. Write down your reasons for exiting and list what you did right or wrong. You will have a pictorial record of your trades and thoughts.
Please like.
This notebook will help you learn from the past and discover blind spots in your thinking. Learn from history and profit from your experiences. This is Richard Davidson for Wiley Audio. Thank you for listening. This audiobook is a co-production of Penton Overseas and Audio Scholar, and is based upon the book entitled Trading for a Living by Dr. Alexander Elder. It is copyrighted in 1993 in the name of Dr. Alexander Elder and is available in print form from the publisher, John Wiley & Sons, Incorporated.
What a beast, Uber and
I hope
Lyft.
you have enjoyed this program.
NIO, I told you guys over the weekend, I'll be starting a position on Monday. I'm up 30% now. NIO. I'm tired of watching that thing. I was watching it from $1.50 a few years ago. So now it's heading to $100. Let's see. All right, let me see what's jumping in the AH. We got CTHR up 19.50% at 109. Nothing much going on. We got GoPro up 12.54% at $7.45. GRPO. What else? AVNW, they're up 12.63% at $23 even. Nothing exciting going on. All right. So my portfolio is up 10% on the week after a nasty October. I'll be cashing out my Robinhood. I cashed out 50%. I'm using the rest for practicing options trading. And then I'll be liquidating the rest. Or maybe I'll do another 50%. It's all about Webull right now. Sign up, you'll get some free stocks. Trading starts at 4 a.m. sharp. When most folks are sleeping, we're making money. Decent prices in the pre. I got in on Altm at 1470, $17 and $16.12. And I sold out 80% of my holdings at 2706. The stock went as high as 3190. Altm, Davesplay. Thanks for tuning into the live. Shout out to I Am Social, K Last, Neville. I'll see you in the morning with the plays.
Sky high, up in the sky. Confidence is so high. You're not the food off of the Rasta man play. I am not ashamed today, my. Just say, don't be afraid today, my. Keep your eyes up and high, you're going to lose your prize and then set your goal high. Should never be ashamed today, my. You set your goals, them up high. Don't be nigga go and talk them up. The big mouth to talk with them ends everything for us high. But mind the people, them that love to see you try. They love to see you lay down and die. And all in the mind that them alone fi try. And not you don't forget no blind. So just spread your wings and soar high. And the eagle up in the sky. And tell the dirt to look like bye-bye. Bye-bye-bye-bye-bye-bye-bye. I am not ashamed today, my. Just say, don't be afraid today, my. Keep your eyes up and high, and don't you lose your prize, and then set your goals them up high. Should never be ashamed today, my. You set your goals them up high. So the nigga go and talk them on the big mouth to talk with the end of everything for us high. I mean, liberty that we a check for. I mean, the one that the life come out, yeah. Cause man have ambition and be a champion. Rise up to your potential. The world is good to live for lead the poor man. In the conflict for survival. Well, in the conflict with the lion. Cause man a work hard towards Mount Zion. I am not ashamed today, my. Just say, don't be afraid today, my. Keep your eyes up and high, and don't you lose your prize, and then set your goals them up high. You should never be ashamed today, my. You set your goals them up high. So the nigga go and talk them up, the big mouth to talk with the end is everything to rust high. Your hands if you're afraid for aim high. But they put them down, raise them up high. Don't take no intimidation. They put your trust in a man, just in a chat. And be most giant. Clean up your heart and clean liberty, yes, sir. And then you shoot up like a rocket to Rasta. You could be a doctor or a teacher. Or a musician just like Yashua. I am not ashamed today, my. Just say, don't be afraid today, my. Keep your eyes up and high, and don't you lose your prize, and then set your goals them up high. You should never be ashamed today, my. You set your goals them up high. So the nigga go and talk them up, the big mouth to talk with the end is everything for us high. I am not ashamed today, my. Just say, don't be afraid to aim high. Keep your eyes up and high, you get to lose your prize. And then set your goals them up high. You should never be ashamed to aim high. Set your goals them up high. Don't be nigga go and talk them up the big mouth to talk with the end of the get out of my time's up. Please come. Forget it. Time's up. Please come. Get it. That's top of the iPhone. Everything you send me with a my own. Money's done. Safe in a Malboro. Rich. Every day, you want your money action. So crack the day of action. Football gas rich. Yeah, this is kind of the jingle thing. I've had a argument for one. I've had a argument for one. But you know, I find myself with that money. And instead of squander it and go on with foolishness and go along with. You want your money action? Subscribe to Dave Natch. Please, me I tell you now. Go on, go make the money now, please. Yeah, man. I'm gonna do it fast and quick here. Subscribe to Dave Natch. Fast, don't stop. Every day, you want the money go, check Davesplay. Invest. Interest. Bless. Contract sign, done deal. Money a pour like gasoline. For ocean, river stream. Attach a case, money gram. Western, got me up on money gram. Money too enough for holding our hand. Some yard, got the money where we have. After when no money fool, buy a condom with swimming pool. Around with everything cash rule. To learn this before high school. Got a lot of money invested in every day. Every day, draw your money out, so crash the day match. Food for gas, got a lot of money invested in a day play. Every day, draw your money out, so crash the day match. Food for gas, rich.
Well, there you have it, ladies and gentlemen. Dave Natch. I'm out. See you in the AM with the plays. Boom, bam. Thanks for tuning in. Good night.